I always tell newbies when they're getting started, I say, you need to be screaming from the rooftops that you're in this business. People don't know you're in the business. They're never going to call you, they're never going to email you. And so you're just going to be sitting on your couch, twiddling your thumbs, not knowing what's going on. It's not bragging. There's no one that's going to go out there and fight and market you like you.
Hi everyone, and welcome to Design Development, your hub to learn direct from top performers in real estate development, design, and construction. I'm your host, Renz Hayes, founding partner of H&O, lifelong learner, and I am personally obsessed with high-powered organizations and the leaders that guide them. If this is your first time listening, thank you so much for tuning in. And if you're a returning listener, welcome back. Let's go. It is my pleasure to introduce today's guest, Ricky Beliveau. This guy has been busy for the last decade. He's running several companies. He has Volnay Capital, Evo Real Estate Group. He has V10 Development. He has other spinoffs. He's hosting events. He's creating a new company this year that's preferred equity that I think comes into the market conversation we dive into today. You're going to learn a little bit about his career. We're going to talk about 2023, what to expect. Are we going down? Are we going up? Do we have something to worry about? If you know somebody that's interested in this conversation, would like to learn more from Ricky's story and insight and expertise, please like, share, comment. It's the only way we get to help more people. But without further ado, let's get to my conversation with Ricky. Please join me in welcoming Ricky. Ricky, thanks for joining us, man.
Thanks for having me on. Really excited.
Awesome. Well, you have an awesome presence in all things social media, so I'm assuming a lot of people are going to know who you are. But for those that haven't come across you, let's give them a little introduction. Who are you? Tell us about your businesses, what you're up to today.
Yeah, so Ricky Beliveau. I am the owner of a bunch of real estate businesses, kind of all aspects of real estate in Massachusetts. So our core business is Volnay Capital. It was founded in 2010. We concentrate on investing in rental properties as well as condo projects, typically 50 units and under. We have V10 Development, which I started with my partner, John Taco, in 2018. That business is formed to do large scale, kind of influential development projects, right? So we've permitted over 1,000 units since 2018, and we have another 700 in permitting currently today. And then we have Evo Real Estate Group, which is our real estate brokerage. I started with two other partners, Ryan Aconi and Jack Ordway. We wanted to take the real estate brokerage mindset and kind of evolutionize it, right? So that's where Evo came from. Wanted to change the way things were done, especially in regards to pre-construction, marketing, and sales on developments for developers. So really a developer-focused brokerage. Volnay Management is my management company. We manage about 650 units. That is a mix of rentals that we own, other people's rentals, as well as condo associations. So my team there does a great job. That business has been growing. We've been in business now coming up on 4 years, 650 units. So very good growth on that. And then our newest venture is Evo Origin Funding. This is a pref equity investment shop. I can get into that a little more as we go, but we realized that there was a missing piece in the market where the loan to value you're able to get on your first position. There is a space there that could be filled by a pref equity on the small scale. It's available on the large projects, but we hadn't seen it on the smaller scale, and I had been doing it with others. So now we formalized it into Evo Origin Funding. So kind of all different aspects of the real estate world.
You're a busy man, Ricky. I've said this before on the podcast, but it kind of seems like you might have more time than the rest of us in your day with all these businesses. How did you, if we talk strategically about launching so many businesses, what was the advantage of doing multiple entities instead of focusing on one entity? Like what went into that strategy of going to all those different angles of the real estate market?
Yeah, and I think that's a great question. It's one of the things that I preach the most when I'm talking and mentoring is this didn't happen overnight, right? And I think that this started in 2010, and every business that has been started strategically and at the right, at a thoughtful time, right? It wasn't that it was just like, oh, I want to start 10 businesses. That's never been the way that I've thought. It's always been, when I first started, I was working in finance and I bought my first rental. I had no intention of being a real estate investor other than as a side business, right? I thought I'd be a portfolio manager at Wellington Management. That was my goal.
You were
right?
educated in finance. You saw the value in holding real estate as an asset, and it
Exactly, right?
wow.
And so Volnay Capital was only formed actually after years of buying rental properties, renovating them, and owning them, doing some condo conversions, but still working at Wellington Management full time. And Volnay Capital it wasn't until my architect finally said to me, he goes, "Hey Rick, like it's kind of time to set up a company and a brand here." And I was like, "What do you mean?" He's like, this is a business now. Like you are a real estate investor development firm. You should have a brand." That's when we launched the branding behind Volnay Capital, which is
Come on. So this came from a tip from an architect as you just were continuing to build real estate assets. They were like, "Hey, you got to start a company. You are the real deal."
well, we were already doing it, but it was just under my own name, under no
Yeah.
branding. And so then it was like in 2013, he brought it up. He's like, "Hey, we should come up with a brand name for you. You're doing a lot of these now. You're owning a lot of rentals. It should be formed into an actual entity." And even when we did that in 2013, I still worked full time until 2016, right?
That was part of my question. So, because you graduated around 2010,
Correct.
5-year program, entrepreneurship and finance, if I remember correctly.
Correct. Yep.
So you're working Wellington Capital, the financial sector, and doing real estate on the side for, was that 6 years to
Correct.
2016 before you exited? Wow, that's a lot of overlap. I like that. And that's how you de-risk the new venture, right?
Exactly. It was all gravy, right? So everything I was making, I was able to reinvest back into the business. So it was like, and it wasn't fast, right? Like I come back to the idea, it didn't happen overnight. 2010, I bought my first rental. 2012, I bought my second rental, right? Early 2013, my third, and then my first condo conversion, 2013, right? So it was like, it wasn't happening. Like I wasn't all of a sudden owning 10 properties. Like this was like a drawn out process of creating a business. But as you mentioned, I was on a W-2 income, making
Hmm.
great money that paid the bills. So everything I was doing in the business could be reinvested into the business to continue to grow. Because as all of you know in real estate, like in the flipping business or in the short-term business, there can be short-term cash flow coming in. If you're buying rental properties, it is a long-term game, right? And so you're
100%.
not going to see those returns in the short term.
Yeah, it's a great point. And something you did there with like you looked at your bills, your cost of living. You don't blow up your lifestyle the second you start doing something, right? You're trying to reinvest in assets and make sure you have momentum behind you as you grow. A way I look at my own income, especially as I've grown through the years, is I think about like what's my minimum viable living number? Where is that? And then what's my normal living number? Right? And then
Yeah.
anything above that, I am willing to put on the line or push into assets that I think are going to have future growth. I'm not looking for the return this month or next month. I'm willing to move that capital. Like obviously you want some rainy day fund, but I'm willing to put that capital to work for future growth.
Right.
And if you do that consistently over time, you're strategic, you're consistent, I think is the most important thing, right? You're committed to the plan. You don't get you don't waver in 3 or 4 months just because you got scared. Like you plan for a 5 year. It's everything's a long term game in my opinion. So
Yeah.
I
Yeah.
love that strategy. We're going to get into the big conversation today is market conditions. I know I love this statement out of you. It's not 2008. I've seen you say it quite a lot. So we're going to get into that. I still want to provide a little bit more context and who you are so that people can understand why we are talking about this. The social media strategy, you were super, super early in Instagram. I think you were on Instagram before I knew what Instagram was, if I, if I look at it. And from the outside looking in, it seems like that momentum, that attention, that audience has really created a windfall that's allowed you to create these other entities successfully. Could you tell us a little bit about like how that started? When did you recognize the magnitude of the opportunity and how has that strategy changed over, it feels like a decade long?
Yeah. So definitely was early in on Instagram, and that was just from a personal standpoint. I think where we differed from the rest of folks was the idea that I realized that Instagram could be something more than a place you just post pictures of your dog, right? And I pivoted and started posting stuff regarding my projects and my real estate and the renovations I was doing. And at the time, it wasn't even anything that exciting, right?
Hmm.
But I was bringing the content and putting it onto my page, right? And at that point, it started getting good traction. People were interested. And at the time, it isn't like now where it was flooded with a lot of people doing it. I was like the only person doing it. So like everyone who followed me was very engaged. My accounts were growing quickly on my personal account. And then that's when I set up the Volnay Capital account. And that account started growing rapidly, right? And I was sharing my own work, and I was sharing inspiration work, right?
And when did you
And
start the Volnay Capital account?
oh my gosh, whenever
Like, is this pre 2016? Is that post like the
it
official?
was
Well, you launched in 20.
20, like yeah, 20, whenever 2015, like
Wow.
yeah,
Yeah,
2015,
super early.
2016. And but yeah, so then what was happening is the account was growing, but what I was realizing I was getting followers from all over the country and all over the world, right? And like that wasn't really what Volnay Capital was about. Volnay Capital at the time was a Boston-based development company.
Mm-hmm.
And one of my friends actually had started a page, it was Dentside Trucks, and he liked posting pictures of trucks, these different types of trucks. And he was actually making money off it. He was selling like wax products and stuff. And him and I got to talking, and I was like, dude, that's really creative. And he's like, you're growing really fast. Like, I was like, you think I could do that for like kitchens or like bathrooms or something like that? He's like, yes, man, Instagram's going to be huge. It will definitely take off.
Wow.
So that's when I started Kitchens of Instagram. And I took what I was already doing on my own pages of sharing my own and other people's inspiration,
Mm-hmm.
and moved that into that account where I was able to then feature my own and others and different creative ideas, which has now grown into a very lucrative business with massive marketing partnerships with different brands, whether it's free tile, free faucets, free sinks, large discounts, you name it, we get it, as well
You're
as
creating value for these other brands to distribute through your audience. And in
exactly.
return, you have buying power, leverage, and support from them, which
Exactly.
when you're doing real estate deals, those add up.
Right. Yeah, I mean, it can be small, right? You're looking at like our 85 unit project. We used Vigo fixtures for our sinks and faucets, and everyone's looking at them and they're, wow, those are really expensive for a rental building. And it's like in my head, I'm like, well, yeah, we didn't pay retail.
Yeah,
Right.
yeah.
Right.
Market
So
value they are, but now they're on your project, which you're promoting. You promote
right.
them. There's a lot of attention. It's a worthwhile investment for them. It's a
Exactly.
win-win situation.
Yeah. And then, I mean, then social media has just grown where, whether it's launching new businesses or deal flow or meeting new people, like the number of DMs that I get every day, and I try to answer everybody and set up calls or emails back and forth with people to say, whether they're working on a project or a new deal or they're looking for capital. It just is the way for, in the new day and age for everyone to stay in touch. A lot of my older mentors, when they saw me doing this, they're in their, 60s, 70s. They thought I was crazy. They're like, sharing what you're doing, telling
Yeah.
people how you're doing it.
Scarcity mindset.
Yeah. They're like, what are you thinking? Don't let people know. We have something good going on.
And what gave you the confidence? That's a really good point. So with mentors, right? We're reaching out to people that have maybe walked our path before we walk it, but at a different point in time. So some things change, and it's important to have context relative to the market that you're competing in versus the market they competed in. And like, how did you choose to filter what advice to listen to? And then on this one, go against their advice and share openly and be visible on social media.
I mean, I think that a lot of them just had no idea what social media even was. They weren't even coming from a place of guidance where they were knowledgeable about it.
Yes.
Right. So and I think when they're thinking, you're just, they're thinking of reach, like, oh, you're telling a direct one person your strategy or what you're doing. Like, no, this is to the masses. And what that does is it allows, I always tell newbies when they're getting started, I say, you need to be screaming from the rooftops that you're in this business.
100%.
If people don't know you're in the business, they're never going to call you. They're never going to email you. Right. And so you're just going to be sitting on your couch, twiddling your thumbs, not knowing what's going on. Right?
You could be the best at what you do, but if people don't know about you, it's never going to be realized.
Exactly. So like what is social media? It's the perfect opportunity for you to self-market yourself. right?
Yes.
And it's not bragging, right? Some people are like, "Oh, I don't like being on social media. It's bragging. I feel like I'm bragging." I'm like, "You're not bragging. There's no one that's going to go out there and fight and market you like you, right? And so
Hmm.
you need to do that for yourself. You're not going to hire a PR firm in our, like guys like you and me, like in our at this size business. We're not going to have a PR firm doing it. You're
Hmm.
going to have to do it."
Agreed. Yeah, I think the business leaders of today need to be visible. I think the best leaders are visible.
Yeah.
And you mentioned something there that I actually personally struggle with on the social media and the content is you have to create a position of like authority, like what gives you the right to provide advice or to speak on these topics or to market. And that's coming from like when you're sharing a point of view. Not everything can be inward focusing. Hey, look at me. This is what we do. You do a good job at you open up live Q&A essentially on your Instagram often about like ask me about this deal and you answer questions openly. Sometimes I struggle with that in terms of like what type of information do you need to put out there to help create the sense of authority, because like let's say we're confident in our authority to speak on a given topic because we've put in the work, we've been executing for years, and we want to share that value. But if we're not, like you said, the bragging part, sometimes you have to put a little nugget out there to show that you've achieved something so that you can help more people. And that's been a big mindset shift for me is like, if the goal is to help more people and to get your information out there, you have to share a little bit to kind of create that sense of authority in that topic.
Yeah, I mean, if you don't have a track record or a reason that people should be, taking what you're saying seriously, then of
Mm-hmm.
course it's could
Or it's a
just
track
fall.
record people know about, right?
Exactly. Right.
That's the hard part. And let's tie this social media up, and I want to move on for the audience. I think as social media, is that part of like what created the opportunity with Evo? You have this real estate presence, more and more people know about you. I'm assuming people are constantly reaching out to you like, hey, can I sell this? Can I sell this? Or you're outsourcing real estate. You're like, I have all this attention. Can I create a brokerage? Did social media play a big piece in Evo?
Not so. I mean, social media played a piece in all the businesses, right? Because it just grew. It grew our branding. It grew who our network was, and the number of people we're able to touch. Our touch points grew. So, what the real formation was, and comes back to the idea of strategic growth, was the first business that started after Volnay Capital was Volnay Management, right? And that was because we got to the point where I was paying third-party property managers, and I realized I was like, well, now I have enough of this going on. This should come in house. And when you bring it in house, you realize that you should expand it and grow it.
Mm-hmm.
Right. And so it became the right time to do that. So we took all of our rentals back from the property managers, started managing them ourselves, grew that business. So now we have, if you look at the different pipelines, we've got Volnay Capital building condos, Volnay Management managing rentals for my rentals and others,
Mm-hmm.
right? Once that business had grown to the point where it really needed, and we were feeding so many deals and so many leads to other agencies, right? It really became the time was like, okay, why aren't these all flowing
You
into one
created the
market?
pipeline already. Why not monetize the pipeline?
Exactly, right. So then we started Evo Real Estate Group, and I think the core, of what we're trying to do is obviously developer focused on really working with developers, understanding the process, being an aid to help them to success, and that's kind of the key of everything we're doing. The from the standpoint of the pre-marketing and walking through, this is all stuff we had been doing on my stuff for years,
Mm-hmm.
right? And then now we've taken it and moved it into the brokerage. And what we with these young agents that are joining is we're taking someone who has no experience, we're putting them onto a Volnay Capital project, and they're able to then see a new construction, learn design, and learn the process, so that by the time that project finishes, they have a lot of experience in the world of new construction. So we're able to grow in that
I want
fashion.
to applaud you on. I want to say it's you almost have like a feedback cycle. You have a feedback loop and an information arbitrage, particularly in your businesses. You're on the construction and development, which you're seeking land opportunities. You understand the market. You're going through construction. You know what new builds are going for. Then you have the Evo Real Estate or the brokerage that is marketing those and pre-leasing. You have better feedback on what people want when you're developing, because they're talking direct to the consumer. And now you have a property management company who one gets to hear what they love about the business, the buildings, what they're complaining about. So now you get better feedback. And if they move, you now have a resource to say, hey, they're moving out, introduce them back to the brokerage. And you have this amazing loop between your businesses. So job well done.
Thank you.
I want to jump into the market conditions, which is the crust of this this episode and what's to come. It's not 2008. And right after that, I think it'll tie in nicely. I want to share more about your new venture this year with the preferred equity, because I think I think those two things tie in really nicely. And you said everything you're doing strategic, and there's a right time for everything. And the timing of the launch of this preferred equity business feels appropriate, right?
Yeah.
So let's give the audience a sense. Why isn't this 2008? What makes you confident that it's not this big market correction or recession as deep as 2008 hurt everybody?
Yeah. So I've been the past, 6 months have been, saying this on social media and preaching it. Now all of a sudden, I'm seeing all these different other people say the same thing.
You were the original. That's your line.
I've been saying it since the beginning.
Trademark.
This is not 2008, and now all these different people are saying it. But in the end, if you look at the actual numbers behind 2008, right? 2008 was bad mortgages, right? Mm-hmm. Bad adjustable rate mortgages with teaser rates that would adjust and put people into financial distress when that occurred, right? Since 2008, the percentage of adjustable rate mortgages is a sliver of the market, right? And that's just because it's actually almost unhealthy. I think 2008 really messed up a lot of people's outlooks on how to use different types of mortgages, right? Those were bad adjustable rate mortgages, right? And that's
why was everyone in 2008 going for adjustable rate mortgages? Do you have insight there?
So it wasn't everybody, right? But there were these large mortgage brokerage firms that were selling these bad mortgages, right? So they would take someone who didn't have the right credit, couldn't afford it, and then what they would offer them is say, I'll give you a 12-month teaser rate at 3%, which will allow you to afford this. And then it's going to go up to 15, right? But you'll be able to refinance it because you'll own it and you'll be able to do a refinance. What happened? Obviously, there was no refinance available. These people knew that. And what it did is it put these homeowners into a situation where they would never be able to afford it and sent foreclosures through the roof, right? So
that makes a lot of sense. So they were being sold that these interest rates were going to continue to go down, so that if they locked into this first year, you're going to be able to refi in a year and be fine. It'll still be affordable. We just don't have that yet. So let's make it variable to get this 1 year of affordability.
Right. And if you look at why this isn't 2008, if you were over the past 5 years, no one was locking in 5-year adjustable rate mortgages.
No, why would you?
I assure you, because the adjustable rate mortgage market is tiny right now, and it's actually going to start growing because I'm doing adjustable rate mortgages now.
I'm hearing that too on the single family buyer side. Yep.
You should if you're a buyer, you should be buying with a 5-year adjustable rate mortgage. But so what that means, right, is that all of those loans over the past 5 years, whether you purchased or whether you refinanced, are most likely on 30-year fixeds or, at least 7 to 10-year rates, right? And I don't know, or 15s. I don't know why anyone would have done a 5, right? We did everything we own fixed for 10, right? So everything we own, from my personal house at 2.7% up to my highest, my rental properties that are at like 3.85, that's our whole portfolio, 3.6 to 3.8. Is refinanced now at those rates for 10. Yep. And I think the majority of owners and people did refinance or buy a new home over the past 5 years.
The mortgage industry was on fire with refis and cash out refis and all that, right?
Right.
So why wouldn't you refinance over the last 5 years?
So now you have people sitting on a mortgage that is an asset, right? They are paying an interest rate of 3% or 3.5% for 10 years. It's the complete opposite idea of what happened in 08. In 08, people were getting hit with 12%, 13%, 15% mortgage, and it was forcing them to get foreclosed on or to have to sell.
And
We're
so
not in that.
let's say that homeowner that's locked in, the cause of these rising interest rates doesn't mean they're in trouble. They're not underwater on their current property. It just means it makes moving to a new property significantly harder, which means they're staying put, right?
Exactly. And they might be underwater. There are people who overpaid over the past year or two, right? And if they look at what their house is worth today,
sure,
it might be down, right?
So let's say underwater, and I maybe am using the wrong terminology there. Underwater, real estate value could potentially be down right now in the short term. But if you're looking at 10, 20 years, chances are you're not underwater. Your value is going to be fine. So it's really, when I said underwater, I'm talking about affordability. They can afford their house because they have the low interest payment.
Right. So they can still value. Right. They can still afford it. And because the value went down, has zero impact on them unless they sell. Yep. Right. And so what will end up happening? You're only going to see sales that are occurring when people are forced to move. What does that mean? There's going to be sales during deaths. There's going to be sales during divorces. There's going to be sales during relocations, right? And growing families, right? Like, that's where you're really going to see these people move. You're not just going to see people pick up and get out of a great house to buy a new house unless there's a reason, right? And what that's going to do, and we've seen it already over the past 6 months, is it's kept inventory levels at record lows, still at record lows. And so I'm a big believer in, whether it's on the development side or anything, of the whole concept of supply and demand. If there is not a supply, prices will remain stable, right? And so what that's allowing is it's still a seller's market. If you are a person that's actually going to sell, there's not inventory out there for somebody to buy. So you are able to still demand a high price because the buyers are in the same situation. It's a buyer who's being forced to buy. They are getting relocated here. They just had another kid, right? And they're in a situation, do they really want to maintain that purchase price? Probably not. But they're in a situation they have to, right? And so I think in Massachusetts, at least, and I'm not an expert in any other market, right? I look at what's happening where we invest. I think we're going to see the market will maintain, right? We've seen small downticks, right, in values, but we are not going to see any large drops. I mean, but if we talk about even in 2008, South Boston went up, right? So
in 2008. Boston was pretty resilient compared to the country, even in 2008.
Exactly. So even in 2008, we weren't really that impacted. So Boston is an investor's anomaly, right? And I think when you're looking at it from the size of Boston compared to the cities across the country, we are seen as a major metropolitan market, and we are a sliver the size of every other major market, right? But we've got the hospitals, the businesses, the growth, that's actually growing and going faster than all those other markets, right? And all of those people still want to live here, right? And so you're going to continue to see that demand.
So let's talk about the affordability piece here, right? So supply and demand. As we were talking and leading into this, and the conversation that actually sparked this podcast episode, we were talking about the supply demand in the greater Boston area. And I think from 2004 to today, the Massachusetts population has risen from 6.4 million to just under 7 million. So you're talking about, let's say rough numbers, 600,000 people of growth. We haven't built that many units to support that growth in the last 20 years, right?
Right.
And with mortgages being so affordable and it's so challenging to move, essentially we're saying the only reason you would move is if you have to, for the reasons you mentioned. What does that mean for the rental market?
Yeah, so the rental, I think what's going to end up happening, right, is the rental market has continuously been rising, right? If you look at the past 20 years, the average growth in Metro Boston is 4% a year on rent, right? That's the average. In COVID, it went down, then it's come back up. But if you average the 20 years, it's a 4% growth rate. So if you're projecting out, a new property, that's a good way to look at it. It's been 20 years. That's how it's averaged up and down. I think you're going to continue to see that even spike further because we're already seeing projects sidelined, right? Because now the cost of debt has gone up too high for construction projects to be able to pencil. Projects that were great projects have now become unbuildable because of the increase in interest rates, right? 100%. And so all that's going to cause is there's going to be less inventory, which means there's going to be more demand for those existing units that are on the market, and landlords are going to continue to raise those rents, right? So, which is also going to have an impact to help maintain the condo and housing market. Because as rents go from 2,500 to 3,000 to 3,500 to 4,000, now these people are living in a two bed and their rent's up to $4,000. Now they're looking at it like, well, I have to spend either $4,000 here or $4,000 on a East Boston condo. Mm-hmm. Well, now I'm at the point where I'd rather own something, right? So it's going to kind of push people to make the move because rent's going to just become unattainable for folks.
Yeah. So in the supply demand there, and I want to talk through both sides of the coin here, right? So we're talking a lot about promoting the stability, in particular the Boston, the Massachusetts market. Where's the breaking point for the demand? Because we're talking about supply demand, and right now there's still the demand. At what point does the rent increase push the demand to leave the Massachusetts and Boston area? So we talk about mortgages, those people aren't leaving, right? And there's a demand to be here. If just looking up some data, like what deems like an affordable mortgage for somebody? And I think the range you look for is like 28 to 32% of your income. Do you have an idea of what percent of income people are spending on rent right now in the greater Boston area?
50 to 60 probably.
50 to 60% of their income.
Yeah.
Which to me is terrifying. And so if I think about what creates demand to want to be in the greater Boston area, we have the access to education, it's the hospitals, it's the city, the history. It is a great place to be. But at what point do people not want to be here? If I think about spending 50 to 60% of my income on a place to live, the only reason I'm going to do that is because I think my earning potential is going to triple in the next 2 years. So I'd be willing to forego a short-term like pinch financially to live in a place that I saw significant growth for me. But if that growth wasn't coming, like what's the incentive for people to continue to pay 50 to 60% of their income on rent?
Yeah, no, I mean, I think it really comes back to the businesses, right? I mean, that's what's going to end up. The one factor that could really change where things are going in Massachusetts is layoffs, right? And pullbacks from our large businesses that are based out of in Boston, right? If all of a sudden you see massive layoffs, now you're going to see a change in the way people are looking at those mortgages, right? Because they won't have any income coming in. But we haven't seen that yet. And I think as long as the demand is still here and people are continuing to be paid these high salaries, you will continue to see people have to live in this area because this is where the jobs are. This is where the new innovative jobs are. This is where the lab jobs are. This is where the tech jobs are. You can't just go and live in, some of it you can now, right? With COVID, you could do it on Zoom. You can go live in Western Mass and work a job in Boston.
Gives people flexibility, right?
Yeah. But we haven't seen that in massive numbers, right? It's like it started to push back to people having to be in the office. If you want to work for one of these companies and make these salaries, you need to be doing it from Boston.
Yeah. So a little side conversation on the work from home thing. I saw a post this past week on LinkedIn talking about Gen Z demanding flexibility and like needing to work from home or work from wherever they want, when they want type of stuff. And this is coming from myself, who is I'm a very open, transparent, super flexible, like work environment, work from home, work from here, work from another state. Like we literally don't care if you've proven competency and accountability, and we measure the outcome. So this is coming from somebody that is pro that narrative. I think the media pushes the narrative a little too far on the Gen Z, saying like they demand X, Y, and Z. It's like Gen Z has only worked in a bull market where it is the employees like kind of driving the bus. The second this thing turns and they don't have money or support from the government to pay their bills or to live on, they start like flexibility becomes less and less important because we need income to sustain our living.
Right. And I mean, I think that's the other thing too. If you look at the actual job, the number of jobs versus the number of people looking in Massachusetts, right? There's way more jobs than there are people looking. Mm-hmm. Right. So we're still in a situation where employers have to be making these strategic decisions, whether paying them more, allowing them from work from home more, all these different things, because there's still a shortage of workers.
Yes.
right? And so that is also a cost to live is probably a reason why the shortage of workers,
Mm-hmm.
right? Which will keep the protection for Massachusetts regarding layoffs because there's just not enough people.
Yeah, 100%. And I think if I look ahead, I'm trying to gather more data and have conversations like this with people like you that I truly value your opinion to to get as best of a gauge on what I think is happening in the economy over the next 12 months to 18 months. I don't think this is 2008, but I do think we're up for a correction of some sort. There's got to be some sort of pause and normalizing based on the new rates and the new affordability. Buying power is just totally different today than it was 12 months ago. So something's got to level. But that doesn't mean me as a business owner, I'm going to be scared and try to make decisions to make more money in the next 6 months. I'm thinking of my business in a 5-10 year cycle. And if I think about where we're going, now is a great time to take advantages of companies that do get nervous, to go reach out to new talent, to build your team, to invest in new products, systems, training, doing things for your top clients. Let's say call your clients your Dream 100. They're going to be more available because they might not be as busy. It's a tremendous time to invest in the long-term growth of your company, right?
Yeah, 100%. You look at some, talking to people from 2008, reading books, you hear some of the most wealthy, successful real estate investors out there made their money out of 2008, right?
1,000%.
And so it's like you need to be in a strategic situation with your business to be able to make decisions from now, right? It's not '08, but it is going to be flat.
If even in a decline, if we're about a 20-person firm growing 50% a year, if a market skids 15%, I'm still planning on growing. I'm not going to use a recession as a reason to stop going. Like it's a $23 trillion GDP. Like I'm going to go chase that. Like we're
Yeah.
20 people. Let's provide value. There's still plenty of opportunity out there.
Yeah, so I read there's time equities out of Manhattan, and the founder of that business. So you read his book, he talks about 2000 in recessions, right, and how in different recessions in his career is when he's had to obviously be able to maintain through them, but make the most of everything coming out of them. So right, so I think this is a great time. I kind of said the same thing when COVID was coming up for people to like step back. Yes, you're not out there wheeling and dealing during COVID, but what can you do in-house? What can you fix in-house from your business standpoint? What can you do on your computer? What can you do, right? And we're in the same situation now. It might not be the opportunity that it was a year ago, but there are opportunities now to plan and be prepared for when the capital does come flowing back into the market, right?
Yep.
So from the V10 standpoint, we are looking at our projects that we have under agreement that are permitting or approved. And we're looking at them like, well, those are assets. Yes, are they immediately financeable, right? The equity markets have dried up. Could I go out and raise the 20, 30, 40 million today for that deal? Probably not, because no one's investing. But you know when they will be investing? 2024, right?
Yeah.
2024.
Your building doesn't open today.
Yeah. But those people are going to be flooding back into the market. Like as we're heading into the election, there's going to be a drive down of interest rates, and we're going to see that economy take back off, and there will be lots of money out there looking for places to be. And I want to be the firm that has more projects than anybody waiting for that capital to come back into the market.
Yeah, I like that angle. And there's you kind of connected that piece of insight there. You're predicting interest rates going back down as we head into the election. Those are going to drive votes because people are going to be happy with that. And that's also why you're saying lock for a 5-year adjustable mortgage, because it's different than 2000. Well, hopefully it's different than 2008, but we're not selling the adjustable mortgage on affordability now. We're selling it because we're predicting that it's going to go down.
Correct. Right. You can if you're looking at adjustable rate now in the like mid 5s instead of a fixed in the high, fixed rate in the 6s. It doesn't make any, like, why would you do a 6.5 fixed rate for 30 when you can do a 5-year at 5.25 or 5.5 when I think we can, most people would say that in 5 years rates will have stabilized, at least come down slightly. I think they're not going to go back to what they were, but I think we'll end up in the high 4s.
Interesting. Because that was one of the questions I have out there is real estate values have had a 40-year tailwind of declining interest rates. And this is the first time I know in my lifetime that we've seen rising interest rates. And it's had a significant impact. If we look at the data, I don't know the exact numbers, but the increase in the average home price from 2020 to 2022 is the steepest increase we've seen in 40, 50 years. Right. And a lot of that has to do with the buying power we're talking about. When you have interest rates down around 3%, your buying power is significant. If you compare a 3% to say a 6.5 fixed, I think if I did the numbers, it was like 34% buying power. You could afford 34% less of a mortgage, which is insanity. And so that's why construction pricing, housing pricing rose so quickly 2020 to 2022 is because the buying power was so significant. So looking at that impact on construction, we talked about right now a great deal before is no longer buildable because of construction prices, and they raise the interest rates so fast. We're literally talking inside of 12 months, a rate hike of north of 3%, which doubled the cost of that debt. When I look at that, what I kind of see in the market, construction is still working off their old backlog that was purchased on the old debt. And they aren't feeling the pain yet of the new purchase power and the reduced construction. So I feel like there's got to be some sort of lag or pause period where construction normalizes in 2023. Because like you said, the numbers just don't pencil. And so once they work off that backlog, they're going to start to see they don't have as much backlog. And that's when prices are going to start to shift.
Yeah, and we're already seeing it, right? I was with one of the largest GCs the other day for lunch, and he was talking me through exactly that, right? Construction prices have already stabilized, started to come down, and he's already receiving calls asking for what projects are coming up. Hey, you got anything, in the pipeline that I should be looking at in pricing? That wasn't happening the past 5 years.
That hasn't happened in years. Yep.
No. And so he goes, as soon as that starts to happen, he's like, you're going to start seeing us burn off our pipeline. And instead of adding 5 projects, we're only adding 2. There's going to be some steep competition. And so on these, from a sub standpoint, they can either make the money up on their margin, right? The owner's margin, right? They can make it up on a material negotiation, on the materials pricing. Is that going to come down? How much push are they going to do on that? And the final step is on labor, right? Are they going to lower what they're paying their employees, right? And so what's going to end up happening is you're going to first see the margins are going to shrink, right? The amount that the sub is willing to make, 500 grand, is going to go to 300 grand, right? Because they're saying, I'd rather have work than no work. I need to keep my guys busy, right?
So it's a capital intensive business. So you have float to cover. So there's risk. It's not just, am I going to make money? It's, am I going to lose money because I have costs that I need to pay?
Yeah. So margins are going to get slimmer, but then we're already hearing of these subs now, right? Going out to their lighting reps or their lumber suppliers and are saying, hey, these aren't going to be able to maintain. I can't pay the 75% premium you raised that light fixture over the past year. We won't have any work, right? And there's going to be a shift and a pushback on those pricing. Supply chain will hopefully improve as long as COVID doesn't come, rolling back and shutting China down again. And then we'll have the ability of supply to be, available.
Yes.
So.
And I'll add to that, my background's in the structural steel industry. And I think the steel mills, the steel suppliers are a pretty good indicator of like where things are going in terms of supply demand. Essentially, if you create a steel mill, it's so capital intensive. Once it's up, you're just producing steel 24 hours a day. It's not dependent on price. It's you have the supply and you move the needle on the price relative to demand because you need to move the product. And you're already seeing, like, I think joist and deck are down. I heard a number the other day. They're down from like what was $19 a square foot to $11 a square foot now. Within 6 months, that's a move, which tells me they're seeing the same thing, that backlog's not there because the construction pricing doesn't pencil anymore on the new debt. Yeah. And to me, I don't know what that pause period is. But with the supply demand, like construction has to move on. We have a housing crisis. We need to create more units. And I'm assuming that stuff has to move. So it's really just a timing thing. And how long is that grace period going to be?
Yeah, I think the key is going to be is when do rates come down to a low enough number, but construction prices have also lowered where it's the prime time to start building.
Do you think they're going to wait for like construction and that type of stuff to normalize before they move the interest rate? Or do you think they're going to move the interest rate before that cycle happens? Because that to me is going to be a big indicator of like 2023 or 2024, like how
I
long.
think you're going to see rates continue to rise in 2023. They're going to keep ticking up. Then they're going to end of 2023. We'll start seeing them level out and stabilize and start the downtick end of 2023 and then heading throughout 2024. That would be my guess.
This rolls right into your new business. So remind us, what's the name of this new business, and talk to us a little bit about what exactly is preferred equity.
Yeah, so Evo Origin Funding, I started with Origin Property Group. They are one of the lead investors on my project in Everett, the 600. And then they put up the largest amount of the LP for our deal in Worcester, the Cove. And talking to them, they had brought up that they were interested in investing in more deals, right? And with me, smaller deals, right? So I had them invest in some of the smaller condo projects. And we continued the conversation, and it was, we kind of have a mutual ground. I had been investing kind of in a pref equity role to other developers around the Massachusetts area, and they had been doing the same thing.
You were already personally doing that before this?
Yes, right. Cool. So we were already investing across the board with developers in a pref equity type of position, guarantee, a fixed return, not an equity stake where we're taking a percentage of profits. It's a fixed return investment. And
is that another term for like hard money loan? You're essentially, is there a duration tied to that money and a fixed rate that you're getting returned?
Correct. Yeah. And it's typically in second position, or it's not, in the operating agreement. It's not actually the first position hard money loan, right? This would be something that sits behind the initial loan, whether that's from a bank or from a true hard money lender. And so once we got to talking, we're like, well, I think there's really a market for this. I've had more people reach out to me than I would have my capital available to fund. And so we teamed up, decided to go for it, started the Evo Origin Funding, and kind of rolled everything that both of our shops were doing and made it a more formalized process. And, now we're off to the races doing, these pref equity, mezz debt type of investments. And as you mentioned, what we're seeing is a lot of these lenders are pulling back, right, on the amount of loan to cost or loan to value that they'll lend on, right? So it means the first position debt has gotten shrunk down, right? And now this leaves a needed gap to be filled with a mezz debt or pref equity piece, which would allow for that developer to not have to bring as much cash to the development or the flip as they would if they didn't have us, right? And so that's kind of where we fit, right? So you take the initial loan and we're able to bring them up, and we still sit behind the equity, but we're able to bring less equity to the deal.
Very cool. And so to share, let's say people are interested in collaborating with you for preferred equity, what type of deals are you generally servicing?
Yeah, so it's typically 9 units and under, and they're almost all for sale projects, right? So it could be anything from a 2, 3, 4, 5, 9 unit condo development, ground up construction, condo conversion, anything like that. Lots of single families, right? We're doing a ton of people who are doing single families around the Boston metro area, Somerville, Cambridge, where we're coming in and we're investing in those deals. We also do just bridge investments, right? We have developers who they finished the project and they have it under agreement, but they've got a $500,000 profit of equity that
realized it yet. So you're floating it between that deal and the next deal.
Exactly. Right. So they look at it and they say, we'll come in. We're very open to how we'll invest. Right. We don't have a set way. So in something like that, where the guy's got 500,000 in equity, but he's got another project underway that he needs cash for, we'll come in, we can cross collateralize them. We can give them $200,000 of the 500 that they're getting at the closing. And then we'll be paid back on the closing. Right. Yeah. So we're able to then, be creative, right? And create.
Yeah, that's a great service. And what's the reasoning behind sticking to a for sale product versus, let's say, an apartment that's a for sale product?
So it's just the
product.
It's just the
transaction.
Yeah, it's just what's the liquidity event going to be to get us our money back, right? We're not in this to be your long-term partner. Right. These are investments that are typically looking at 12 to 24 month term. So they need to have a strategy to get us back our capital.
For sure.
And in the current environment we're in, right, with cap rates where they're at and refinancing and lenders pulling back, when we've had these, people come to us with these opportunities, and when I run the numbers, I say, that's all well and good, but I'm not sure that in 12 months, when you think you're going to finish this and refinance it, that bank is going to give you enough to pay us back, and as well as your first position. So it's kind of that careful balance, whereas on the exit, it's more predictable.
You're not going to, the probability of having a cash event from recapitalizing after a lease up is much lower than it was a year ago, right? 2 years ago. And that's the thing you're talking about. Very cool. And let's say somebody was looking for a partner in a development. It might not be with your preferred equity company, but you are a real estate developer, whether that's Volnay or V10. So you might still be interested.
Yeah, and I think that's the other thing too. It's like we're not, we're bringing more to the table than just the equity, right? We can just be the equity, right? We can just give you a pref equity investment, or if you need guidance, answers, introductions, subcontractors, right? First position lender, introduction to a trustworthy hard money lender, right? These are all things that we're happy to provide. So it's not that we're just, hey, here's the money, don't mess it up, or we're going to take the project. It's, hey, here's the money, we're going to work with you and try to make your project successful, right? And our hope is that we're going to be able to build these guys up, and that this becomes repeat business where they're coming to us and we're working together.
Yeah, you might work with, like, these potential partners could partner in every one of your businesses over the next 5-10 years, right? And that's the beauty of what you've done. I give you a lot of credit. That's amazing. I want to wrap this up, and I always say this, but we could probably continue to talk all day and let this go live. How is your investment strategy changing in 2023, given the economic climate and everything we've talked about today?
So starting on the rentals, buying rentals and investing in rental properties, it's the same exact strategy. It's just, you just need to adjust for the new world that we're in, right? So I'm a big believer in it all comes down to the numbers in investing in real estate deals, right? And you just need to be honest with yourself regarding what the expenses are going to be and what the interest rate is going to be, and what the rents are going to be. So it's still, people are like, oh, you can't buy right now. Of course you could buy right now. If someone's selling at the right price, I'm always a buyer, right? Yep. The problem is, as we're seeing, stalemate, is that the expectation of the seller isn't adjusted yet for what the buyer is willing to pay, right? So we bought a property last week or 2 weeks ago, but other than that, we don't really have anything in our pipeline from a purchase of a rental standpoint, just because we make offers. It's just those buyers haven't realized yet that their value is not what they thought it was.
They don't want to be the first one to sell at the new reduced rate. They're going to wait to
see.
The thing
is that they're not going to sell because rents are going up another 5 or 10%. And so now their cash flow is even better. So from their standpoint, they're either own it outright or have a great mortgage. They're in the same situation. They're not going to sell. Right. So it's going to be a harder time to buy rentals, but you can, in the right situation, still make a rental property work. Right. And then on the development side, I think it's a great time to be strategic in your entitlement process, right? This is a great time to find raw land or something that needs, that can be entitled. And you can spend the next year or two going through the process of getting the approvals and getting to a building permit, right? Because then you'll be sitting on an asset. You created a ton of value without actually having to own the asset. And if you're doing it with the proper contingency. And this is a great time to do that, right? So we're going to continue to do that. We're going to continue to entitle the properties around the city for condos, right? If we can get a piece of land for the right price, we will still work to permit it. Just continue to, just be a little bit more careful and stress those interest rates, stress those numbers, take haircuts on all the sellouts to, make sure the projects still work. But, we've always looked at these deals. When we look at total project ROI, we're trying to be between a 20 and a 25, right, percent our total project ROI. So we can take significant haircut and still get a great profit on it. Sure. Where you start getting into trouble is a lot of these guys will send us deals and they're looking at 10, 12% total project ROI. if the sales price get hit by 10%, you're breaking even.
You're toast.
You
Yeah,
know,
you got to
and
have a
so
buffer in there in the return, and
exactly.
that's part of the real estate game is a long-term game. And if you're always playing, but you're building your pro forma for a 20 to 25% ROI, and you understand your downside drops to 10, right? You're still above water, so you're not going to be hurt. But if you look at over time, like a 10-year cycle, right? You have a recession for a year or two, but you have 8 up years. So if you're playing the game enough, your probability of hitting it on the up is significantly high.
Right. Yeah.
Awesome. Ricky, I love everything that you're doing. I applaud you on your strategic thinking, your ability to build partnerships and invest with others and create these alliances that, one, help run the businesses, and two, partner with you in all things real estate. So I wish you the best in 2023 and beyond. And I'm going to close with 2 questions that I ask everybody. Is what's a book or a podcast that you would recommend to our audience?
Yeah. So a book that really inspired me the last year was Can't Hurt Me by David Goggins.
That guy is intense.
Intense, and you'll be running through walls. If you start either reading or listen to it on Audible, because they do in between chapters, they actually do like open dialogue about like the chapter with him. And so it really gets into some of the more details. So on Audible, Can't Hurt Me, David Goggins.
I've been aware of that book for years. I never put it next in the queue. So it's something I got to pick up and listen to. And the last piece, the emerging leaders out there that are listening, what's the best advice you have for them?
Yeah. So, I'm going to repeat it again, right? It doesn't happen overnight, and you need to be strategic about how you're growing your business, right? Do not all of a sudden think you're going to be the expert and that you're going to do, make a jump into a huge, investment. Work your way up the ladder, follow the right process, be successful at one thing, make your way up to a little bit bigger, and then you'll be able to be successful as you head forward, right? But don't bite off more than you can chew, and put yourself into a situation where you're over your skis.
Yeah, that's really great advice. If I were to add to that with my own words, I like to find strategies and things that I can work on that have low downside risk, where if I fail or if I lose, I don't lose much. My life more or less stays the same. But if I'm right and the upside is significantly greater, I look for like disproportionate returns on the upside versus the downside. And I think that's super important to focus on that kind of stuff in years like 2023 and 2024, when the future isn't as predictable as it maybe once was.
Yeah.
Awesome, Ricky. Thank you so much for spending the time with us today. And you're out there on social media. So if people want to learn more about you, connect with you, engage with you and your companies, what's the best place for them to reach out?
Yeah, you can find me. It's Ricky Volnay on Instagram. You shoot me a DM on there.
Awesome. Ricky,
thanks for having me.
Have a great day, man.
Thanks, dude.
Everyone, can't thank you enough for tuning in today. I hope you got a ton out of today's conversation. And if you could do us one favor, if you did get value, please like, share, and comment. Subscribe on whatever channel you're tuning in on. Please leave a review. It helps us expand and grow and support more people. That's the end goal. We want to bring the insights of these amazing guests to as many people as possible. Thank you.